Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. Yesterday was Subscriber Request Tuesday, and yesterday I covered Hewlett Packard Enterprises. But I've also been asked by subscribers to cover Hewlett Packard, Inc., the printer company. And, what Hewlett Packard Enterprise was spun off from Hewlett Packard in 2015. And created a second company. And companies do this. I think something that people don't understand, because I know we're going to get a lot of questions coming up on Johnson & Johnson, which is going to be doing a similar approach to what we saw with Hewlett Packard back in 2015. Companies typically do this so that the businesses, the remaining, or the two businesses, once they're split up, can operate more effectively in their core businesses. And so I thought it'd be interesting to look at Hewlett Packard and what was going on with the company prior to the spinoff of Hewlett Packard Enterprises, and then focus a little bit on what's happened after that. And of course, I'll also be talking about the investability of Hewlett Packard, the printing company, as well. So let's go ahead and turn to FastGraphs and let's look at that. So I'm going to take price off of the graph here temporarily because I want you to see some things that were going on in the business. Okay, coming out of the recession of 2001, we had a down year in earnings, which was understandable. It was a recession. Then that was followed by several years of very strong growth. And I want you to notice that Hewlett Packard actually did very well even during the Great Recession. Dividends were frozen, but the earnings of the company grew very nicely at double-digit rates, actually, during that period of time. But then from 2011 up into 2015 and 16, actually all the way through to 2017, really, I do want you to notice the company's earnings growth dropped. It fell 17% in 2012, 12% in 2013, eked out a 5%, year-over-year growth in 2014, minus 4% in 2015, then minus 2% in 2016. But this is where they spun off Hewlett Packard Enterprises. Now, this is a $36 billion market cap company. Before I go on, let's take a real quick look at the stock I covered yesterday, which was the spinoff Hewlett Packard Enterprise. I want you to note that Hewlett Packard Enterprise is a $19 billion company. Now, the earnings growth rate since they were spun off from the parent has been 8.97%. So going back to HPQ, which is Hewlett Packard, which is now the corpus of the main company, the earnings growth had really stalled. Now, at long-term growth, it averaged 8.15%. But if I shorten this, you can see that the growth rate coming out of the Great Recession, I can increase that just a little bit so we include the recession years, was really pretty anemic. Earnings went from $1.75 actually down to $1.60, $1.65. So we actually had negative earnings growth during this time. But then in 2015, the company spun off Hewlett Packard Enterprises. And, at first, of course, there was some obvious operating issues. So there was no growth in 2015 or 16. Then they started to grow in 2017, had tremendous growth in 2018, had good 11% growth in 2019, flat growth again. But then in 2021, now part of this is COVID inspired because people were working out of home and it actually increased demand for personal computers, printers, and printer supplies and stuff like that because people were working out of their home rather than their office. And we saw this nice big 64% increase in growth. So the point is now all of a sudden we've had double-digit growth, if you will, since they've spun off the business. And if I shorten that even more, you can see that growth has been up to 17%. Now, going forward, we're not expecting that kind of growth. I think that's very important. But let's look at stock price, and let's go back to the big graph, and let's bring weekly closing stock prices onto the graph. And what I want you to see is that coming out of the Great Recession, Hewlett Packard stock price was tracking its earnings. The correlation was very high there. Then the recession came, and even though their earnings did well, the stock price fell. That gave you an opportunity to buy the stock at fair value for a short period of time. But then when their earnings began to falter, you can see the company was very weak during this period of time. If I just run my mouse along here, price earnings ratios were 4, 5, 6, 7, 8. I mean, the market was giving it no value really whatsoever at that point in time. Now, since we've had the spinoff of Hewlett Packard Enterprises, I also want you to note, and this is very important when you're analyzing whether you should be investing in this stock or not, the market, just like we saw yesterday with Hewlett Packard Enterprises, the market's only been willing to give it a 9 multiple since the spinoff, even though the company's earnings growth has accelerated as much as I indicated to you here so far. So, what you've got here is a company that's trading at a very low multiple. Now, if I look at performance from this time frame when it was, reasonably priced based on the market multiple at the beginning of the spinoff time, and look at it, through today, it's averaged about 11%, 11.4% annualized rate of return. And I also want you to note that the dividend record has been kind of interesting during this time frame. So, let's look at performance. So it's averaged over 11%. The market's done 13. It's produced more dividend income than the market and slightly less growth than the market. But it's not too far off, okay? Again, remember, the market is trading at a PE in excess of 23, and Hewlett Packard's only trading at a PE of 9, okay? I want you to make sure you understand that when you're looking at it. So the company's dividend growth rate has been exceptional during this time frame. They've really increased their dividend a great deal, and I think it was just yesterday or the day before they announced a 29% increase in the dividend from 78 cents to $1. So everything's going in the right way. The company's offering a dividend yield of 2.48%, which is above market, a fabulous earnings yield of 12%. That's, of course, attributed to the fact that the blended PE currently is only 8 times earnings. But again, the stock has only been trading at roughly 9 times earnings. Now, there were times, in 2017 and 18 where we got into some double-digit PEs, 12, 13, 14, et cetera. And so that's not unreasonable to expect that. So let's look at the future now of the company in terms of what we would expect if we invested in it today. So let's look at forecasting. Earnings growth is expected to average about 14% over the next couple of years, but that includes the big surge we had in 2021. We're expecting 9% growth in 2022. And by the way, this company has an October fiscal year. Please note that. And then we're looking for about 3.5%. The long-term growth rate, 3 to 5 year growth rate, is expected to be over 20% by the analysts, reporting to FactSet. So there is growth in the future. One of the big bright spots of this company is 3D printing. All right, we'll talk about that a little bit later. But this is Hewlett Packard since the spinoff, and that's what I want to focus the rest of this video on. Rather than looking back at the long-term record where their business was slowed down until they spun the company off and unleashed the growth, really for both entities to grow better, in my opinion at least, this is what the Hewlett Packard that we're dealing with today. Okay, now diluted earnings are GAAP earnings. I've been showing you non-GAAP earnings up to now. There have been some accounting convention included here, but even on a diluted earnings, the blended PE is only 8.6. So the company looks very inexpensive on that regard, not just relative to the fact that it ought to be trading, in my opinion, at around a 15 multiple at least or better. It's only trading at an 8.5 or 8.6 multiple. It's also trading below its normal 10 multiple based on diluted earnings. Now, it's a dividend payer, so let's look at free cash flow. I always like to go to free cash flow. And again, you can see since 2015, we'll ignore this year here, the company has been generating good, solid free cash flow growth. And, it's well covering the dividend. So I think that's really important. I also, as you know, like to look at operating cash flow, and operating cash flow growth has also been extremely strong. Averaging about 5% growth. But the point I want to get at is we're really covering the dividend. We're generating $3.04 of operating cash flow to cover a 70-cent dividend in 2020. And then in 2021, we had almost $4 of cash flow covering a 78-cent dividend. We're expected $4.64 of operating cash flow to only cover $1 worth of dividend. So, it looks very strong there. If I look at it from a standpoint of EBITDA, which is another cash flow metric, the company's been trading at around a 6.5 times EBITDA. It's trading at a 5.77 times EBITDA. There's some expectations of EBITDA flattening out, but the reality of it is it's inexpensive at that level. EBIT or operating margin or operating profit looks real good. This is earnings before interest and taxes. The company looks very inexpensive on that basis. And finally, on a sales basis, the company is trading at about 0.6, 0.59 to be precise, actually 0.6 times sales. but that's been its historical average since, the spinoff. So it's trading in line with its price to sales. So all in all, the company looks very attractive. It's triple B rated, which is my minimum threshold for these, as you know. So, everything I see so far, I really like about the company. I think it's a very attractively valued company that the market has been, discounting in terms of giving it a fair value multiple. So when I look at forecasting, if I go to the normal multiple of about 9, I've still got an opportunity to make double-digit returns next year. And remember, the fiscal year ends in October. And I've still got over 14%, almost 15% rates of return expectations if it hits these earnings estimates. And so far, it's been doing quite a job on the earnings estimates. It's actually been meeting or beating estimates in recent years. And again, we're only really want to look at this company from 2015 going forward now, because that's the company that it currently is, if you will. All right, so when I'm looking at forecasting, if it ever gets back to a 15 PE, you could really make a lot of money even in the short run. And that is not necessarily an impossibility. I got close to doing that back in 2018. So let's turn to fund graphs now and look at some of the items that I, feel are, real important for us to look at, which I'm refining, by the way. I do want to make a point on that. This is something we're really looking at and we really think is going to really help us. We're going to add this as an actual process where you can go directly. We'll be adding another tab here where you'll be able to go directly into this and hit these items one at a time for your convenience. We don't have that loaded yet as we're developing this new product, but we will. But first thing I want to do is I want to go into the millions graph, and I want to go into basic shares and diluted shares outstanding. And, Hewlett Packard has about an $8 billion buyback and dividend program going on right now, share buyback program. They've been reducing their share count from 1.7 billion shares to 1.4 billion. So there's been a nice, that's making it shareholder friendly and helping us with keeping the earnings per share going up. I'm going to then next go to cash flow from operations by going into the operating cash flow. I'm going to go into the income statement here, and I want to see net income, and then I want to look at it versus operating cash flow, and I want to see operating cash flow higher than net income. Now, that's been the case the last couple of years, but there have been times where, the net income was higher than that, and that means weren't necessarily utilizing their cash as well as they could. I'm going to then go look at sales and revenues here because I want to see the trend in sales and revenues. And, total revenues have kind of flattened a little bit. But the other way to look at revenues is to go into per share revenues with these share buybacks. And if I look at revenues per share, they've been increasing at a very nice rate, even though gross revenues haven't. So that's part of the benefit, if you will, of, buying back stock. Now I want to next look at net income growth. And I see that net income has been faltering a little bit. But once again, if I go to per share and look at net income growth, the picture's a little better. Other than for 2018, we've had a nice little increase in net income. So that's, pretty good. The debt to equity ratio would be what I want to look at next. So I'm going to go into the ratios here, and I'm going to go into the liquidity ratios. Let me get rid of the profitability ratios. Go into the liquidity ratios and look at debt to equity ratio here. And I see the debt to equity ratio is actually negative right now, which means the company has negative equity. If I look at returns on equity, there's negative returns on equity as well. So that's understandable given what's been going on with all the share buybacks, et cetera. So then I want to go into the balance sheet and I want to look at total equity versus total debt. All right, so I'm going to go back into the millions graph here. And again, we're going to create this so you can go right through this without having to bounce back and forth like I'm doing here. And we're going to look at total equity, which is negative, as I pointed out. And then we're going to look at total debt, and we're going to add total debt to that. So, the reality of it is they've been, using debt, and at low interest rates, that's not necessarily a bad thing, but it is not something that I'm real pleased with. I would like to see the equity a little better, but as long as they continue in the process they're going, that's probably not going to happen. Now, I'm going to go back into the ratios graph here, and I'm going to look at profitability ratios, and I want to see gross and net margin. Well, I've got very good gross margins at about 18% and moderate net margins down at 5%. And the company does generate different margins through some of the different aspects of their business, which I looked at, through some research. So next I'm going to go back into the in millions graph here and into the financials, if you will. And I want to look at sales revenue, and I want to look at that versus the balance sheet and look at it versus assets versus total assets to see how, well they're turning over their assets. And I'll call this moderate. This isn't really great, but it's not bad. They're barely turning over their assets twice, throughout the thing. Now, if I go back into the ratios graph and look at the profitability ratios again, and I'm going to look at returns on assets, the company does have about an 8% return on assets, and it's actually improved a little bit in the last quarter. So I kind of like that. Return on equity, which is, troublesome because it's negative because they have negative equity. So that's a negative, if you will. Operating margin, which is EBIT, divided by sales is, let me get rid of this one here, get rid of total assets, is they've actually got a lot of operating margin here. So that's really not too bad. So I kind of like that. So all in all, the company is, doing pretty well considering all the metrics that I like to look at. We've got good earnings growth. We've got very low valuation. We got a decent dividend. It's an investment grade credit rating. And, there's always that possibility that the market ends up being forgiving. Now, some of the things that are really interesting about this company, I think that I want you to look at would be the fact that the company's always reinventing itself. And I like that when I look at companies like this. And so they're, really moving into this 3D printing business. And the 3D printing business is something that's, offers an awful lot of potential. There's a lot of competition. There's companies like Stratasys and others out there that are doing it. They're kind of a late entrant into it, but this company does have size and scale, and they do have a lot of expertise and the ability to, really compete in this marketplace. And that's a very promising sector for them. Their regular printing business has benefited from COVID, if you will. You saw that in the numbers. That has to do with the fact that people are working out at home and not in their offices anymore. So that stimulated demand for PCs as well as printers. And worldwide, they do about half of their business internationally. So it's a pretty interesting company. It's one of the tech stocks you can buy today at a very low valuation. So anyway, that's my take on HP or Hewlett Packard, in conjunction with my take on Hewlett Packard Enterprises. In yesterday's video, I hope you enjoyed this series of videos looking at the two companies. And, and I hope you got a little bit out of how companies can spin off and, separate their businesses like Hewlett Packard did in 2015 and actually benefit shareholders by doing that. Hopefully we'll see a similar thing with Johnson & Johnson, which I've been asked to do videos on that. I'm not ready to do videos on Johnson & Johnson until I get a little further into what I think the company might be doing. Anyway, hope you enjoyed this video. If you have, give me a like, ring the bell. Subscribe to the channel if you don't already, and take a look at FastGraphs. We're getting real close to launching this new version, and we're real excited about that because it really does offer a whole lot of enhanced potential for you to be able to analyze stocks faster and deeper than ever before. Anyway, thanks for watching.